If your trades keep failing, even when your process is solid, that does not make you a bad trader. You're just missing key information. This is a very common short setup. Price breaks under the low of day and then pulls back into it. The question isn't if this is tradable. It's how do you know whether sellers are actually stepping back in to defend this region. One way to do this is through a heat map. At 10:40 a.m., price pulls back into the previous low of day, and here we can see a large aggressive market buyer transacting for 770 lots. The size itself matters, but what matters more is how price responds to this level. This response will tell us whether this is true buying or a passive seller absorbing buy orders to defend the previous low of day. Roughly 4 minutes later, price trades back into the level and is rejected back downwards. It returns again shortly after and fails a second time. Following this rejection, a passive seller appears for 110 contracts. Price then again moves lower, and this confirms the presence of a passive seller defending the previous low of day. Another way to see the buying and selling activity is through a delta footprint chart. Here is the activity we've been discussing, and here we can also see an excess high, which is a high that's rejected quickly, leaving low volume, signaling active selling. With this information, it's clear that sellers are defending the previous low of day, and this is the information that justifies our short setup. So the normal methodology that a lot of new traders are taught when they first get to markets, or even experienced traders, is a methodology that focuses on things like candlesticks, indicators, trend lines, support and resistance, etc. And this information isn't unusable. A lot of people make money with this stuff, but it is very limited comparatively. And when we're using information that's limited, as a result of that, our decision-making skills have to be limited. Think about your trading system as the inputs being the information that you have access to, or the information that is at your disposal. Think about the outputs as the decisions that you make and your perception of the market and how you interact with what's going on. If the input is limited and the information that you have is limited, then by default, your decision-making skills and processes have to be limited, because there's only so much that you can do with limited information. There's only such quality decisions that you can make as a result of using a system where the information or the input is limited. Okay, so for example, let's say that you are looking to long above high of day right here using this system. You have candlesticks, trend lines, indicators, etc. Like this chart right here. Price breaks above high of day by 1 ticks, 2 ticks, 2 points, doesn't matter. What this trader is most likely going to do is long that breakout. Now, that trader is going to long that breakout because he assumes that price and volume are going to have the strength to carry price beyond that level and towards higher prices. And the reason he's going to assume that is because he doesn't have access to volume that would suggest otherwise, or tools that would suggest otherwise. There is no access to be able to tell that sellers might be stepping in here, or that the buying volume might be exhausted. And both of those things would more so indicate and suggest to us that prices are going to move down. So as a result of not having that information, of having limited information, his decisions to be in the market are going to be limited. So another example of this that I want to touch up on is how traders using this type of system are very reactive to price. So right here we can see price making this downside move. And when most retail traders see price moving down, they just short. They short because they think price is going to keep moving down. And what happens is that oftentimes they'll get an entry right here. So of the sellers that sold on this move, most of them very likely got filled right within this candle. Now, the most optimal location for an entry on this downside move would be up here, because the return is maximized and the risk would be minimized. However, a trader using this system doesn't have the tools, doesn't have the access to volume or to the information that would actually allow them to see that there were sellers stepping in here, or that the buying volume was exhausted. Therefore, when price is right here, they are not going to be entering short. They're going to be entering short after the move has already happened. So, in essence, by using a system like this, our skills and our decision-making processes are limited because the information that we're using is limited. You're not necessarily a bad trader, or people that use the system are not necessarily bad traders. You're using information that is bad. Not bad. A lot of people make money with this, but it's limited. And so we can compare this with order flow. Over here, this is a heat map, as you guys saw earlier. This gives us the full story. This gives us access to the information that we cannot see over here. I can see aggressive orders, passive orders, and ultimately I can see how the auction is unfolding and how the buying and selling relationship is unfolding as price moves throughout the session. So I want to walk you guys through an example. The time is about 9:50 over here. The price is 6936.5, and that would be over here. 9:50 candle, 6936.5. So as you guys will see through the order flow, a lot of traders are shorting this move here. A lot of them think the market's going to keep going down, but by looking at the order flow, we could have actually stayed out of that move as a result of having information that allows us to see what's truly going on in the market, which we can't see over here. Okay, so I'm going to replay this. We'll walk through it step by step. It's going to be in 10 times speed, so it's going to move quick, but take note of this 602 amount bid sitting right here at 3.5. So that bid got filled. And then price is going to shoot up like a rocket right here. Okay, so we can start over here and then talk about what's going on over here. So price moves down lower and there's a bid sitting right here. Now, passive orders, which are all of these lines that you guys are seeing, they only have relevance if they get filled. They can pull, but this order right here, not only is it very large, but it got filled. So as a result of it getting filled, now we need to look at the reaction. So just because it's a bid, just because this is a passive buyer sitting here, does not mean that prices are going to move up, and it does not mean that the amount for which prices, or the amount for which that bid is defending, is going to be strong enough to hold that price. There could be an active seller here applying more aggression with strength to pull prices lower and to move price beyond this level. Okay, so waiting for the reaction is going to be very important. It's either a true buyer or a true seller. Now, price consolidated and nothing really meaningful has happened since this guy got filled, but then price shoots up very fast right here. Now, what this is telling me through the order flow is that this is a true buyer. It's a bid looking to defend this price. And now looking at the candlesticks, most traders that are looking at this information just see an opportunity to to short the market. They think that as a result of price pulling up a little bit higher, that it's a better entry for them, they can risk less, and that they can get short the market. The bottom line is that they do not have information that we have over here, and they don't know the activity that's going on at 6935. However, this is the conventional method, and most people don't have access to this information. Okay, so I'm going to keep replaying this data. I want you guys to keep a close eye on 6935. 6935 is the level where this bid appeared, and I'll be showing you guys the replay further to see how price responded with this area. So right here. Most traders are shorting over here, but if we're patient and if we wait, as a result of looking at the order flow, and since we infer that this is a buyer, reasonably so, we can wait for a pullback. And when price pulls back into this level, watch what happens. It's going to happen soon. I'm going to speed this up over here. Boom, 6935 to the tick. Watch price just immediately blast off to the upside. So this move ended up going much higher than this price point right here, from 6935 all the way up to 6963, 6960 supply right here, or 6959. And by using candlesticks, by using this limited information over here, most likely we would not have been able to ride this momentum to the upside. But by looking at the order flow, we can see what was going on, and we can see that there was a passive buyer sitting there that got filled, and the reaction allows us to infer that that is a true buyer looking to defend those prices that we can long when price pulls back into, to ride that momentum back to the upside. So that's going to do it for this video. Be sure to subscribe if you guys want more of a look into this content. If you guys have any suggestions or comments, be sure to leave them down below. And yeah, Happy New Year.